Good day, everyone, and welcome to this Easy Equities webinar with Satrix on innovation in the midst of turmoil, the NASDAQ 100. I'm Sean Keeling, and today with us we have Kingsley Williams, the Satrix's Chief Information Officer. So welcome, Kingsley. I hope, just to start, I hope everyone else is doing well in the lockdown, and it's awesome that tomorrow at least we're going down to level 4 and we can go for a walk or a run, or at least get out the house for a little bit, which would be great. So as long as you're keeping safe at this time, that's great. And just to let you guys know, for any other information after this webinar, if you're looking for stuff on ETFs, please check out our new Easy ETFs platform, which is designed to help you find the best ETF. Just type in easyetfs.com and it'll take you there. So thank you for joining us, and over to you, Kingsley.
Great, thank you very much, Sean. Trust you can all hear me. So yeah, the title of my topic today is innovation in the midst of turmoil, and I'm going to specifically focus on the NASDAQ 100 index, which we as Satrix have an ETF that tracks. But before I get into that, I just wanted to show you who the team is. So this is me on the right here. I'm the Chief Investment Officer at Satrix. I look after the investment team. And Helena is our CEO, so she runs the business overall. We also have a team that's based up in Joburg. Some of the members of this team actually sit up there as well. So Duma and Yusuf. Yusuf looks after our ETF specifically. But yeah, we're a tight-knit team. There are about 20 of us in total, but this is the investment team specifically. And yeah, we've all been working from home during this really strange time. And I can really echo what Sean was saying. Can't wait to be able to get some fresh air in the lungs once we get down to stage 4 with being allowed to exercise. Where Satrix is as a business is we did actually cross the 100 billion in assets under management at the end of last year. Obviously, we've had a significant market correction with this COVID-19 crisis and turmoil. So that has reduced our AUM down to 90, but this is at the end of March, and we're quite keen to see where that number lands at the end of April, given that we've had quite a strong recovery since that point. In terms of where the business is, I mean, we run a significant range of funds, whether it's in ETF form. There's the 15 there, which we which we manage in ETF form. We also run unit trusts, which are available to end investors. And then we run a number of other products and vehicle types and strategies which service our institutional client base. But yeah, the business is doing well, and we've adapted quite well despite the difficult situation that we all find ourselves in terms of working from home. So zooming into the NASDAQ 100 specifically, I thought it's useful to give some context on how this index is constructed and what it aims to achieve. So unlike other indices which we have product tracking such as MSCI World or even the S&P 500, those tend to be far more broader indices and encompass the full market economy of whatever segment of the market they look at. So in the case of MSCI World, it looks at the developed market universe. S&P 500 looks at the US large cap universe. What NASDAQ 100 does is it looks at only the stocks listed on the NASDAQ exchange. So in the US, you've got the New York Stock Exchange, which is a competing exchange with NASDAQ. And the S&P 500 would look at stocks across both those exchanges, regardless of where they're listed. Whereas the NASDAQ 100 index looks at only stocks that are listed on the NASDAQ index. And I'll talk a little bit more about that. The index also specifically excludes financial stocks. So it's designed to be sort of an industrials real world economy index, capturing businesses that are actually producing things or servicing clients in various ways, and outside of the financial services sector. But coming back to the NASDAQ exchange itself, what you'll find is that the companies that list there tend to be more newer generation, new economy type businesses, very technology dominated, and quite tech savvy in the way that they do things. That doesn't mean to say that all the businesses are tech businesses. There are a lot of consumer services, consumer staple type businesses that are listed there, and I'll talk more about those in a bit. There's also healthcare companies, and there's very topical information on some of those at the moment, as well as even industrial companies. So, you know, PayPal is classified as an industrial company, even though it obviously utilizes technology quite extensively. And then it's quite interesting that, you know, this index does exclude financial stocks, because that sector has taken quite a lot of pain with the recovery, or with the correction that we've seen year to date. And the reason for that is quite simple, that if you think about financial services businesses, they're really a leveraged play on either the market or the economy more broadly, particularly to the extent that they lend to individuals and to businesses. And obviously, as everyone is worried about what the economy is going to look like, and with the economy contracting, if you have a leveraged play on that, you can imagine that financial companies like banks and companies that lend to other people are going to be you know, underperforming relative to businesses that are more resilient. So moving on in terms of sector exposure, I'm going to compare this to the S&P 500, because that's probably the closest comparison we can come up with, given that they both US focused indices. What you'll notice is that the NASDAQ 100 has a very strong overweight position relative to the broader US large cap market in the form of S&P 500. So sitting with close on 50% weight in information technology companies. And I'll go through that list in a second on the next slide. But you'll see that there's also overexposure to communication services. So those would be the likes of ICT companies. So, you know, Cisco is one of the top names in the NASDAQ 100. It makes routing equipment. And you can imagine, you know, their products and services have been quite in demand in this lockdown environment, and with everyone working remotely or working from home. But what's interesting is also consumer discretionary, and that would, you know, be the likes of Starbucks, for example, and perhaps they've gone through quite a tough time, but they're also represented in this index. What's quite interesting as well is the NASDAQ is known for its biotech companies, but actually relative to the broader S&P 500, it's actually underweight on those companies. And that's presumably because within the healthcare sector, there's a lot of different types of companies. So you'd have hospitals, you'd also have pharmaceutical, biotech companies focusing on various areas of specialization. So that's what the NASDAQ 100 is well known for. But obviously, you know, there are a lot of other companies operating in the healthcare space. And then what's interesting is you can obviously see the financials is a big underweight. There is a slight weight to financials in this chart, and that's because it's using a slightly different classification system. It's using the S&P's classification system, where there may be some companies that NASDAQ doesn't view as financials, or views as financials, which S&P, you know, which S&P doesn't. So anyway, that's just a slight classification issue. But other thing that's also interesting is that there's no exposure to energy or materials. And, you know, if you've seen in the headlines lately, with oil having, you know, the futures contracts on oil going below zero because there's an excess supply in the market and limited storage. So no one wants to take delivery of those contracts, which are coming to expire at the end of the month. And so as such, the futures price went below zero, which is quite unprecedented. But anyway, NASDAQ doesn't have any exposure to those types of companies either. And just in terms of which of these sectors have done really well year to date, unsurprisingly perhaps, is healthcare has been one of the top performers, followed by information technology and consumer staples. The companies that have really struggled have been financials and energy, which again is primarily driven by oil. And yeah, so that would explain, and you know, bear that in mind, that would explain a lot of the performance differences that I'm going to show you on the next few slides. But before I get to that, let's just dive into some of the larger companies that make up this index. So I think we all understand what Microsoft, Apple, Amazon, Alphabet, which is essentially the old Google. There's two different stocks listed, but those both make up what's called Alphabet. Facebook, Intel, you know, they make chips. Netflix, we all understand what those businesses do, and I think we can easily appreciate how many of those businesses, particularly those largest ones that I've read out, would have fared quite well during this work from home lockdown situation, as we become more reliant on technology, more reliant on shopping from home and having things delivered to us, which obviously Amazon would do a lot of. Making sure that we connect with our friends and family, which Facebook facilitates in a great way, as do many other platforms with these other technology providers such as Microsoft and Alphabet and Google. Netflix actually had record new subscribers, which they published recently in their latest market update. So, that's easy to understand. But what's also interesting is companies like PepsiCo. That's a massive, massive organization. In fact, they've been in the news recently in South Africa because they acquired one of our fast-moving consumer goods companies, Pioneer Food Group. And if you're anything like my family, actually, I've got my family listening in and watching me present, which is one of the novel things I'll miss, I think, once we return to some form of normality, is they don't ever get to hear me present to clients. So it's actually quite a privilege having them with me. But if you're anything like my family and my kids, we love Doritos, and that's just one of PepsiCo's many brands that they own. Moving on to the biotech space, there's two companies in that in this list here. The one is Amgen. You'll see I've classified it there as number 14 under healthcare, as well as Gilead Sciences. Both these companies are involved in manufacturing drugs and pharmaceuticals to treat various conditions. And in fact, Gilead Sciences, I was doing research on this company yesterday just to understand what they do. And, this seldom happens, but I read a letter on their website, from their CEO and their chairman saying that, they're in phase 3 of doing clinical trials of an antiviral drug called remdesivir. I hope I've pronounced that correctly. It's remdesivir. And later on yesterday, a whole lot of news broke on Bloomberg and on the various financial headlines about this exact issue and how this drug has shown really promising results in the treatment of patients who have COVID-19 or coronavirus disease. And so their stock has done obviously exceptionally well in response to that news that came out yesterday. And obviously the drug hasn't yet been approved for use anywhere, but they're still in clinical trials and near the end of those clinical trials, and are expecting initial results towards today or early in May. So we're watching that space closely. And then lastly, the 25th largest stock is Mondelez. That's how it's pronounced apparently. And they own, again, consumer staples brands which we consume on a daily basis, such as Cadbury's, Oreo, Toblerone, Philadelphia cream cheese, if you've ever had that, biscuits, I don't know if you remember those, and even Royal baking powder. These are all household names which we know and are very likely to continue consuming despite the fact that we are stuck at home and needing to work from home. So how has the NASDAQ 100 done long term? So what I'm showing you here is just a chart I pulled off a website called barchart.com. This is looking at total returns. So what I mean by total returns is that we, any index pay, or any of the companies within an index pay out dividends. But when you look at total return performance, it assumes that you've reinvested those dividends back into the index. So we're looking at total returns, including the impact of dividends over a long period of time since midway through 2007, all the way up to essentially the 28th of April, which is 2 days ago. Now, you'll notice that the shaded area is actually the NASDAQ 100, and over that period, it's delivered on a cumulative basis almost 404%, whereas the S&P 500 is only 150 odd percent. So, but I think before I talk about, obviously it's performed extremely well over this long period of time. Have a look at this period over here, which was during the global financial crisis. And you'll actually notice that, the index lost close on half its value during that previous crisis. If you look here on the right, you'll see minus 50%. So both the S&P and the NASDAQ 100 went down, almost lost half their value during that crisis. And you'll also notice that the S&P 500 took about 2 years to get back to its July 2007 level, whereas the NASDAQ recovered in about half the time. After about a year, it was back up at its levels midway through 2007. So it's quite interesting how they both suffered quite similar drawdowns. The NASDAQ slightly less, but recovered. The NASDAQ recovered in half the time and recovered much quicker. And that trend has certainly played out, and I'll show you that on some more recent slides on a year-to-date basis with the current market turmoil we're in.
Sorry to disturb you there, Kingsley. I see a few questions come in. Guys, can we just wait till the end of the presentation to do the questions, and Kingsley will answer them?
Yeah, sorry. Thanks for that. I forgot to mention. Please do log your questions, and I'll certainly Sean will help me respond to all of those at the end. Just to put these returns in context, because cumulative returns can be quite deceiving. So I've annualized those, which means you work it out in terms of an average annual return per year. It doesn't mean you're going to get that return every year, because in some years there'll be negative returns, and in other years there'll be positive returns which offset those negative returns. But if we look over this entire period, the average annual return from the S&P 500 was 7.6% per annum over almost 13 years, whereas the NASDAQ 100 delivered 13.5% per annum. So it's outperformed on average by almost 6% each year. But as I mentioned, that's over this long-term period, over the entire period. It doesn't mean that every year it's going to outperform by 6%. So I'm going to look now at year-to-date performance of this index, firstly in dollars. And the previous slide I showed you was in dollars. And this is quite important to remember, because when we invest in rands, there's a currency effect at play, which I'll show you in a second or two on some subsequent slides. So firstly, let's look at S&P 500 on a year-to-date basis since the end of last year. You can see that the market kind of went up a bit further till about midway in February. And then it lost significant value relative to the end of last year. In fact, it lost about 30% of its value relative to the end of last year. Developed markets in the form of MSCI World were quite closely aligned. Remember, the US makes up in excess of 60% of the MSCI World, of the developed markets. So it's going to be dominated. Whatever MSCI World does is going to be dominated by what the US is doing. Playing out, but obviously other developed markets have lagged even more than what the US has. Now I'm going to plot the NASDAQ 100 in dark blue, and you can see that it had obviously done quite a lot better pre the correction, having been up close on 10% or even more than that. And then when the correction came, it went down to almost 20% below its end of year levels at the end of 2019. But what's quite interesting is that this index has recovered all of its value in dollars relative to the end of last year, and is now pretty much flat from where we were at the end of last year. So, from the NASDAQ 100's perspective, it's been a volatile time with these gyrations in the market, but over this period, we're actually flat and no value has been lost. So that's quite an interesting phenomenon, and it's essentially at this point just on a year-to-date basis between 10 and 15% ahead of where S&P 500 and MSCI World are on a year-to-date basis. So that's quite a stark performance difference, and I think it's telling in terms of the type of companies. That's happened because of the type of companies that the NASDAQ 100 gives you exposure to, or has, if I should rather put it this way, has overweight exposure to relative to a broader market index like S&P 500 or MSCI World. Those indices do have exposure to the same companies as the NASDAQ 100, they just have a lower weight. So let's turn our attention to what's actually happened in rands, because when we invest in these types of strategies, we are ultimately experiencing two drivers of performance. One is how the index is performing in dollars, and the other is how the index is performing, or how the currency is performing, how the rand-dollar exchange rate is changing through time. As we know, we've faced two significant events in this period from a South African perspective, which have resulted in significant depreciation in our currency. The first being that, we were downgraded, after it being expected for a long period of time. And so that would have had an impact on the currency. And then obviously the COVID-19 compounded that even further with the lockdown situation and everyone being forced to stay at home. So those two things, it's been a very much a risk-off environment. So, that's contributed as well to global investors selling emerging market currencies and investing in more developed market currencies or safe haven currencies like the US dollar. So our currency has weakened, or put differently, the dollar has strengthened relative to the rand, and that has had an amplifying effect in terms of the performance that we see on the NASDAQ 100 when we look at it from a rand perspective. And this is, by the way, the kind of performance that you would experience in an ETF listed in rands, as our product is tracking this index, because you get rand exposure to this offshore investment. So, what's quite interesting is that with the depreciation in the rand, this NASDAQ 100 went up almost 20% before the correction. But with the correction, it was only marginally below where it was at the end of last year, about 5% down. But it's now more than recovered those losses, and is now, in excess of 30% relative to the end of last year, which is quite a staggering outcome given the turmoil that we're in. I mean, even the more broader developed indices such as S&P 500 and MSCI World are up relative to the end of last year. And this is purely a function of what the currency has done. Because as I showed you earlier, the broader indices such as S&P 500 and MSCI World are still down in dollar terms. But in rand terms, they're actually up, and up quite strongly. And I think it's important at this point to highlight that this is obviously a significant risk that you face with any offshore investment. As much as the rand depreciating can help to cushion and insulate losses which happen offshore, it can also hurt, particularly if the rand starts to recover or strengthens. And it has in fact started doing that since the end of last week. So yeah, I mean, we're seeing fantastic performance here in rands, but it does carry a very real health warning in that the currency plays a significant role in what the end outcome will be for such strategies that are invested offshore. Just to highlight that risk in another way, I've plotted what we call a year-to-date drawdown chart, also in rands, of these three indices. And you'll see that, relative to the highs that we've reached, these indices pretty much lost about, the highs were reached in sort of late February and have lost about close on 20% of value, but then they've recovered that again in rand terms. You'll also see that the NASDAQ has recovered quite a lot, or slightly quicker than the broader indices. It's taken about 1.5 months, whereas the others took close on 2 months to recover. And what's interesting about this recovery is that it's actually been, as much as we're living in these unprecedented times, this correction has equally been unprecedented, both in terms of the magnitude of the drop as well as the speed of the recovery. There's actually been some other research done within the Sanlam Investments Group that has shown that the larger the drawdown, the more likely the recovery is going to be V-shaped and tends to happen twice as fast as what you would expect relative to the long-term returns of those indices. So, in fact, on average, the worst drawdowns in our local market were on average about -40%, with the average time to recoup losses being 9 months. So you can see how short this recovery has been. Obviously, we don't know what the future is going to hold, and how the markets may react. It's actually been quite a strange thing seeing how the markets react, even though we are still in the midst of this lockdown situation globally. It's been quite amazing to see how the markets react. And I guess there's a lesson in that for us, which is to remain invested, despite this volatility, and stick to a long-term strategy with your investments. All right, so I'm just going to conclude with a few final thoughts, and then I'm happy to take some questions. So I guess this is probably a question that may be at the top of your minds. Is it too late to get in? And there are certainly risks with investing. But before I answer this question, I think the point I want to make is that it's never too late to start saving. But I want to answer this question by referring to a quote, which I found quite insightful. This quote was, I accessed this quote at the end of January, so before the crisis hit, and it was written by David Booth to his client base towards the end of last year or in the early parts of this year. He said that we'll never know when the best time to get into the market is because we can't predict the future. And if you think about it, that makes sense. If the market's doing its job, prices ought to be set at a level where you experience anxiety. It's unrealistic to think the market would ever offer an obvious time to get in. If it did, there would be no risk and no reward. And I mean, this really rings true to me because, it's easy in hindsight to say, I'm just going to flick back to this dollar chart here. It's easy in hindsight to say, yeah, I should have gotten over here. But with the market selling off like this, it's the last thing you want to do because everyone is disinvesting, everyone is selling. So to be contrary and to buy into the market at a time like this, when you don't know that it's going to do that and you fear that it may continue going down, that's why it's always difficult to know when to invest. So that quote really rings true to me. So the question is, given that investing will always have risk and uncertainty, what are some of the strategies we can use to easily mitigate that risk? And what I'd like to touch on is this concept of Rand cost averaging, which is nothing more than disciplined or systematic saving. So for example, if you were to use a debit order, you can ensure that you continue building your nest egg on a monthly basis or whatever frequency you choose to invest, and remove the timing risk from that decision. Remember, there's timing risk from what the NASDAQ 100 is doing in dollars. There's timing risk in terms of what the Rand dollar exchange rate is doing. And then there's timing risk in terms of the combination of those two. But if you stick to a disciplined saving approach of investing every month, that risk almost goes away because if markets are cheap, you end up buying more units. If markets are expensive, you end up buying less for a given amount. So that's the first point I'd like to mention. You take out the timing risk by investing in a systematic, disciplined, and regular way. The question you might be asking, well, isn't the US and particularly the NASDAQ 100 index quite expensive? So, I mean, the short answer is yes. The NASDAQ has a PE ratio of almost 27 at the end of last month, might even be higher now, given that it's recovered. Versus the S&P 500 of about 22.5. But I guess the question there is, we can't, or the point is with those valuations, we can't really ignore the US given how it drives global markets, as well as how companies within the NASDAQ 100 drive global innovation and growth, as we've touched on. I have actually, out of interest, seen some other next generation indices, focusing on various growth mega trends with a PE ratio, would you believe, in the 90s. So relative to those indices, NASDAQ is obviously expensive in absolute terms, but relative to a PE ratio in the 90s, it's super cheap. So yeah, it's not that expensive. Okay, I'm going to move on to another topic, which is, how would such a strategy, such as the NASDAQ 100, fit into a broader portfolio? And to answer this question, well, I mean, firstly, this is a portfolio construction question, which will be different depending on what each investor is trying to achieve, and in particular, what their risk tolerance is, what their investment horizon is, etc. But, from a South African investor's perspective, we have limited exposure to technology companies. And what we do have exposure to is primarily one company in the form of Tencent via either Naspers or Prosus. So, if you're worried about having your only exposure to tech type businesses in one company, the NASDAQ 100 is a great way to diversify that away so that you don't have that single stock risk while still having the tech exposure. Another sort of theme I'd like to pick up on is that the NASDAQ 100 is considered a large cap growth index. Now, there's two phrases in that, large cap and growth. Now, those are styles or factors which aren't traditionally associated with long-term rewarded excess returns. So, for example, value investing would be associated with delivering excess returns, as would small-size companies. So growth is not value, and large cap is not small size either. So, that might give some sort of concern about, am I investing in an index which over the long term may underperform? And certainly, since the global financial crisis, growth has been the strategy that has done really well. Value has really struggled. So, should that turn around and value companies as well as smaller companies start outperforming, then you could expect that the NASDAQ 100 would tend to lag relative to other strategies. Similarly, the US has done very well since the global financial crisis, and particularly over the last few years, the more recent years. If that were to turn around where other developed markets start doing better, then again, that would be a headwind to the NASDAQ 100. So those are some of the risks to bear in mind. But if you are looking for growth and you are looking for innovative companies, then this is a great place to get it. Another factor or style of investing that's worth touching on is the fact that even though these companies are growth and large cap in orientation, there's a lot of the companies that pick up a well accepted and highly regarded explanation or source of excess returns, and that's the quality factor. If you think about what the quality factor typically delivers is it's more resilient returns, particularly in times of stress, and we've certainly seen that play out with how this index has performed year to date. So these companies would also be the companies characterized within the NASDAQ 100 do have an element of quality to them, given that they are so resilient. They do generate high returns on equity. So that is consistent with long-term rewarded sources of excess returns. Okay, finally, is this a long-term investment? And I've sort of touched on that. But I think the point I want to make is that with all investing, the amount of risk taken needs to be appropriate to your risk profile. Key input into your risk profile is the time you have before you may need that investment for something else. So what is your horizon that you're investing for? The general rule is that the longer your investment horizon, the more risk you should be able to tolerate. And so if this is building up a nest egg for, something that you need in only 7, maybe 10 years time, then this strategy would certainly be appropriate for that kind of, would be more appropriate for that kind of investment horizon than, say, something you need for the next year or two, where you could see a significant correction in the value of this index and therefore actually, which could result in a loss over that time period. So risk, your investment horizon drives your risk profile to a large degree. Now, remember, this fund also only represents a subset of the global investable universe and has active exposures to particular styles, sectors, as well as the US relative to, say, the S&P 500, MSCI World, and even MSCI Emerging Markets. By the way, all of those are indices that we track and have available as ETFs in RAND form that you can. Now, MSCI World and Emerging Markets combined essentially give you exposure and access to the global investable universe. So if you've got those in your portfolio, then you're not missing out on anything. There's no FOMO as a result of not having exposure to any of the stocks in the global equity universe. But you can always then tilt with that base to something that's more niched, such as this strategy, to get exposure to these more innovative companies that are really at the forefront of innovation and growth in the US market. So I think that's where I'm going to leave it. Happy to take some questions, which Sean will facilitate. Thanks very much.
Thanks a lot, Kingsley. I really thought that was great and very informative. So thank you for that. I must apologize when I introduced Kingsley, I called him the Chief Information Officer, not Investment Officer. But after that, you can slide with a lot of information in there also. So sorry for that.
No problem.
A few questions rolling in here. Seeing as we're comparing the NASDAQ and the S&P 500, can you briefly discuss the weightings of the companies on the S&P 500? Seeing as Infotech probably has a large weighting.
Yeah, so I'm going to just flick back to this slide and then to the next one. So it's actually interesting. I was looking at the largest weights in the S&P 500, and you'll see that a lot of the same companies certainly are in the top 5 within the S&P 500. So the names are the same. These are the largest companies in the world. But what's different is this last column here, which is the weight. So they would have, I think Microsoft's weight is in the 2 to 3% range, if I'm not mistaken, as opposed to a much higher concentration within the NASDAQ 100. So that it would just have lower weights to all of the companies. It's a broader index. It's got 500 names in it, as opposed to the 100, which sit within the NASDAQ. And then it's also got broader exposure from a sector perspective to things like energy and materials, which would be, your resource type stocks, to real estate. These and obviously to financials. That's the big one that would exist within S&P 500 that NASDAQ 100 doesn't have exposure to.
Great, thanks, Kingsley. The next one is, how often does the Satrix NASDAQ 100 get rebalanced?
So yeah, that gets rebalanced on a quarterly basis, if I'm not mistaken. And really that would just be to take account of, it's a market cap weighted index. So all it's doing is making sure that the 100 companies that are in that index are the largest 100 companies at a regular interval. So obviously what's going to change are the companies down in the tail, the 90 to 110. Some of the smaller companies that may not have made it in the previous quarter may have had a better performance. They may have raised capital from shareholders during the quarter. They may have, issued new shares, for example. So, there's going to be changes down in the tail of of this index, which are going to be fairly insignificant from a weight perspective, given that the weights are dominated by the larger stocks. And those companies down in the tail will change. But I think it changes on a quarterly basis, if I'm not mistaken.
Thanks, Kingsley. The next one is, why is there a big tracking error between the actual index and the ETF? Is this where the currency risk is coming in?
Tracking error between the index and the ETF, yes. So if you look at the index in dollars versus the ETF, which is priced in rands, you're going to see massive performance differences. However, if you are looking at both in rands, there's another factor at play, and this is a bit of a technical question or technical response. But the ETF is valued as at the end of our day, which is obviously when our market closes at 5 p.m. South African time. Now, if you think about it, the NASDAQ has exposure to US stocks only, and those have only just started trading. In fact, trading starts at about 9 o'clock US time, which will be about 3 p.m. our time. So those stocks would only have been trading for 2 hours and then have the rest of the US day to continue trading, which is when the index closes. So there's a whole lot of performance on a daily basis, and the same would apply at month end if you're looking at this on a monthly basis, that isn't captured in the ETF, which would pick up only the next day, but wouldn't be within your period that you're looking at. So that's probably your biggest source of tracking error that you're seeing if you're looking at the index and the ETF in rand terms. but you're not losing any of that performance, because you will get it, whatever happens after the South African market closes, that will be reflected in the value of the ETF the next day.
Thanks, Kingsley. The next one we have here is, coming out of COVID, will managers be changing their asset allocations? Should we as South African investors invest locally or globally post-COVID?
Yeah, that's a tough question, and a lot hinges on what you're saving towards. So, if you're saving and investing within a retirement structure, such as a pension fund or a retirement annuity, there are limitations on how much you can invest offshore. In fact, there's a regulation called Regulation 28, which limits your offshore investments to 30%, plus an additional 10% if you want to invest into the rest of Africa. So that's the most you can invest offshore within those vehicles and product types. However, if it's discretionary saving, then that's fully taxable. That's after tax money. You can invest in that as you choose. So, yeah, I advocate for having a mix of both. I think if you are based in South Africa and are living here and are planning on living here for the foreseeable future, I don't think you want to be in a position where you have no exposure to our economy. Certainly investing offshore can diversify your portfolio as well. But remember, if the currency strengthens significantly from where it is now, and the view in the market is that our currency is significantly undervalued, and so if anything, the balance of probability is that it will strengthen from here. I've also seen some research suggesting that, when Brazil was downgraded to junk status and when Russia was downgraded to junk status, their currencies devalued quite significantly initially, but then strengthened post that. So there's a sort of an initial shock, which is exactly, I think, what we've experienced with our currency post the downgrade news, post that becoming official. And then from that point, the currency tends to recover. That was certainly the case with Brazil and Russia. So, if that happens, any investments that you have made offshore are going to face the rand strengthening as a headwind in terms of performance, which you won't have to the same degree if you're investing in our local market. Another point to also mention is that depending on which index you invest in locally to get South African or JSE exposure, a lot of the businesses on our exchange actually get, generate their profits and revenue and earnings from offshore activity. So it's not that if you invest locally, you've got no offshore exposure. In fact, a significant portion of our index is made up of offshore earnings. It just happens that the company is listed locally. And a classic case of that would be the likes of Naspers with its exposure to Tencent. Tencent is the moneymaker, which is purely dominated by earnings in China and globally. So it's not to say that if you invest locally, you're not having any exposure to what's happening offshore or getting exposure to the global economy, because our companies are certainly trading and have business in the global economy. So I hope that answers your question. It's not a straightforward answer, but I think it hinges very much on each person's unique objectives of what they're saving towards, which vehicles they're saving within, what their investment horizon is, what their risk profile is, and ultimately what they're trying to achieve. So I can't give a one-size-fits-all answer.
Great, thanks, Kingsley. Next one is, could you please explain the impact of the rand appreciation, depreciation on offshore investments?
Yeah, so the easiest way to think about it is, in fact, I wrote an article for Satrix about 2 years ago, shortly after I joined and shortly after we had listed these products, because there were a couple of other questions regarding this phenomenon. and the impact they have on these products. And the specific case was that I think the question was on the S&P 500 at the time, that in dollar terms, this index, the S&P 500, over the period that this particular investor was looking at, it had actually appreciated. So if you look at the S&P 500 on any websites, you know, Google or Yahoo Finance, in dollar terms, you would see that it had gone up. But then when you looked at your Satrix S&P 500, ETF, you'd see that it was actually down relative to where you bought it. And like that didn't seem to make any sense. And the reason for that is because of what the currency had done. So the way I like to think about it is, think about it in terms of dollars relative to rands, because then the direction is the same. So if the dollar is appreciating relative to the rand, i.e. the rand is weakening. Normally we talk about it in terms of the rand relative to the dollar. But if you flip it around and you say if the dollar is appreciating relative to the rand, i.e. the rand is depreciating, then that's going to benefit your offshore investments. So in other words, the currency is another factor. You want your currency to go up as well. So talk about it in terms of the currency you've invested in. You've invested in dollars, you want that to go up relative to rands, i.e. you want the rand to depreciate. But then obviously the converse applies as well. If the dollar is weakening relative to the rand, i.e. the rand is strengthening, then that's going to be negative for your offshore investments, because you've invested in dollars, but now the dollar is weakening, i.e. the rand is strengthening. And so that's going to represent a headwind to your investments, even if the underlying investment, such as the S&P 500 or the NASDAQ 100, is appreciating. That can easily be offset by the move in the currency. It just depends which one is moving the most. So I hope I've explained that, but happy to elaborate further if it's not making sense. You can actually equate it to, if you were to buy something offshore, say you order something from Amazon, a product or special, something you couldn't find here. Well, maybe it is something you can find here, but you can just get it at a better price because you're buying it through Amazon. So you're going to buy it at today's exchange rate. And let's just keep things simple. Let's assume it's 18 today. Now, if you buy that thing, and let's just say you buy it from Amazon, but you leave it in the US, you don't ship it here. Now, if the dollar strengthens and the rand weakens to 19, that thing's going to be worth more, right? Because the rand has weakened. It's going to be worth more in dollars, and it's going to cost you more in rands. Sorry, it's going to be worth the same amount in dollars, but it's going to cost you more in rands. It's going to be worth more in rands because the dollar has strengthened and the rand has weakened. And similarly, if the rand, if the dollar weakens to 17 versus the rand, from 18 where it is today, for example, that means the dollar has weakened relative to the rand, or put differently, the rand is strengthened. Now that thing's going to be cheaper, and it works the same way with investments.
That makes sense. Thanks, Kingsley. This next one sort of builds on that one, asking, is it better to invest in rands NASDAQ 100 or invest directly in dollars in the NASDAQ 100?
So yeah, a big question, a big factor there is where are you going to need the money when you disinvest? So it shouldn't really make a difference, but the question is, what are you ultimately trying to achieve? So obviously it's a little bit more difficult to invest in dollars because you've got to actually get the currency offshore in the first place, which requires exchange control approval and filling in additional paperwork. I think easy equities do make that, or can facilitate that process. But if you don't want to go through that extra hassle, then you just buy it in rands and you're going to get the same effect. But I guess it all hinges on where do you want the money, and that's probably going to drive your decision on which currency to invest. If your if your long-term view is that you want to disinvest and use the dollars at some point in future offshore, well then probably makes sense to externalize first. But if you're ultimately going to use the money here in South Africa, well then you're going to have to bring it back to SA anyway, which is going to involve more admin, and then you might as well just invest in the locally listed rand feeder fund. But your performance will be the same from a standard currency perspective. So if you invested in dollars and you look at that from a rand perspective, performance should be very similar to what would be the case if you just invested in the rand ETFs that we offer.
Thanks, Kingsley. I have another one here, and I think we have time for a few more if you do, Kingsley. That's cool.
Yeah, I'm happy.
Okay, we have one asking about, can you please elaborate on the drawdowns? What do you mean by drawdown?
Yeah, so I'm just going to flip through these slides quickly. So I plotted this chart on year-to-date performance. So this was based to the end of December 2019. And you'll see this shows you what the market has done. What its journey has been on a cumulative return basis. So we based it to 0. You could also base this to a nominal 100, and then this would grow. Instead of showing 30%, 30-something percent here, it would show 430 if we started at 100. So it would show the same shape, but I've just put it in return terms. But what this shows, what this sort of somewhat hides is what the downside risk is, and that's what a drawdown chart aims to capture. So you can see we went up here, we went up to about 20%. I'm assuming you can see my mouse on my screen. Sean, can everyone see my mouse?
Yeah, we can.
Yeah, okay. So what drawdown measures is from this point here, how much value did we lose? What was the negative return that you experienced, or the loss, if you want to look at it in return terms, from this point to this low here? And similarly, from this point to this low here in red. And on MSCI World, from that point to the bottom point here in light blue. So that's what that chart shows. So it's a bit difficult to read that on this chart because you're going to go from 20 to, maybe -5. So that looks like it's 25, but because we're dealing with percentages, the numbers work out a little bit differently. In fact, it's not that much. It's only 20. So from the high here, that was the high. So this is just looking at downside risk, at the risk of losing money. That's what this chart plots. It doesn't plot gains that you're making. It's just looking at what your downside risk is. And so you can see when the market had those losses in rand terms, we lost just over 20% of value on the NASDAQ 100 and maybe 23% on the other two. That was the loss in value. And then obviously when it goes back up to the 0 line, it means we've reached the previous high. And so we've recouped all those losses. And so what you can see here in terms of time to recovery would be from this point here, which was, I think, about the 21st of Feb, when the market started falling, to our recovery, which was sort of the first week in April. And so that's about a month and a half in terms of the time it took from when the market started falling to getting back to its previous high. And you can see that on this cumulative chart as well. You can see that exactly there. So that's about 21st of Feb, 20th of Feb, and then that's when it got back to the same point in the first week in April. So it corresponds to this picture here, but it's just looking at downside risk as a measure of risk. And you can also see that obviously the MSCI World and the S&P 500 took slightly longer to recover. They only recovered closer to the middle of April in terms of getting back to their previous levels. So I hope that explains it.
That makes sense. Thanks, Kingsley, for that one. We have another one here asking, how do ETF products tracking the same index of different companies differ, i.e. between Satrix and Signia's products tracking the S&P 500?
Yeah, so there'd be a couple of things to consider there. The one would be, the simplest measure to look at is what we call the total expense ratio, which is a measure of the fees and expenses embedded in the fund to deliver it to the end investor. So that's the simplest thing to look at. There's also a measure called transaction costs, which tells you, what expenses are incurred in trading the product within the product itself to rebalance, etc. So that's one measure of comparing it. But another very important measure is the spreads involved to trade in and out of the product, because that also represents an entry and an exit cost getting in and out. So those would be sort of some of the factors to consider. And then finally would be tracking error, but that, as I mentioned earlier from the previous question, because of the timing difference of how our ETFs are valued at end of day, when the JSE closes versus when the index is valued, which is at the close of the US, tracking error can be quite a difficult thing to measure on these products, because they've got different conventions in terms of how they report that tracking error or report their performance. But yeah, ultimately it's about what's accessible, and then I think what insights are being provided, and also whether the strategies, does the product house have other strategies that you're looking for? Because I think it kind of makes sense to have all your strategies sitting, if you're dealing with Satrix, you know who they are, and you know what their products are about, and the way that we talk to them. So I think all of those things, those can often be softer issues, but they all play into the decision-making process.
Thanks, Kingsley. We have one more question here for now, and it goes, Donald Trump has taken a much more aggressive approach to COVID, which will see more pain initially, but perhaps a return to a better economy more quickly. How could this potentially affect the index?
Yeah, I tend to steer clear of forward-looking statements, as well as anything in the political space. So probably not going to give a very comprehensive answer in that regard. But look, I think what we can say is that the US has been, even pre this crisis, their policies and their fiscal stimulus and monetary stimulus with quantitative easing, etc., has been very supportive of growth strategies, which is why the NASDAQ 100 has done so well relative to the broader market, and why value as a strategy, which over long time periods has shown to offer excess returns, has really struggled over the last 10 or so years. Now, what we do know from from this COVID-19 response by various governments is that the US has injected a lot of stimulus into their economy to shore up the obvious, obviously the impact that it is having on their GDP. And I think what we've seen in terms of the reaction of the markets has in large part been a function of that. So the sharp drawdown that we've seen was an indication of how bad this could be. We've seen the sharpest and quickest drawdowns in history with this COVID-19 correction and the crash. But then we've also similarly seen the sharpest recovery that we've ever seen in history. And that's in large part, I think, due to the monetary and fiscal stimulus that's been injected into the economy by various countries around the world, and the US in particular, to support their economies in this crisis. And it's also been obviously supported by the fact that, there's a lot of focus on companies and medical expertise and medical professionals finding a cure and a treatment, effective treatment to coronavirus disease. And obviously we spoke a little bit about that in terms of Gilead Sciences and their drug that's in final phase testing. So yeah, look, I think unless there's a wholesale regime change in terms of the US's approach to responding to these market turmoil and situations, I think we can, there's certainly grounds to expect this to continue going forward. But I must again reiterate that, the South African rand dollar exchange rate plays a big factor in what you're ultimately going to experience in rand terms. And if that strengthens, we could be, you could see a headwind in any, on all your offshore strategies. And we've certainly seen the rand strengthening I haven't checked what it's doing today, but certainly since Friday and as at the end of yesterday, it had strengthened quite a bit.
Okay, thanks, Kingsley. That's one more question came in while we were talking there, and it's, why do some tech companies not pay dividends, and do you think this will change?
Yeah, so a couple of reasons for that. I mean, some tech companies are in the early stages of their growth cycle, and so they are either not very cash generative and would rather reinvest into their, so it could be a combination of factors. They could either be not generating sufficient cash flow from their business because they're still in the early startup phase, or perhaps a more reasonable explanation is that or another explanation or factor would be that they see more exciting growth prospects with the capital that they've got and the profits they generate to reinvest that back in the business. They believe it's in shareholders' best interests to reinvest that back into their own business than to distribute the profits out to shareholders. And so obviously it goes back into the business to be reinvested into new R&D activities, new research, new business opportunities. So that would be, those would, I think, broadly be the two reasons why they wouldn't generate or declare dividends to their shareholders.
Great, thanks, Kingsley. That's all the questions there are for now. I think maybe we call it there. I don't know if you want to wait a bit for more, otherwise happy to call it there.
Yeah, I'm just having a look at the currency now, and see it's trading just above 18, about 18.10 according to my sources. So yeah, it's obviously strengthened from where it was, which was just over 19 not so long ago, towards the end of last week. So that's quite a dramatic weakening of the dollar relative to the rand, i.e. the rand strengthening, and that would obviously present as a headwind to any offshore investments.
And thanks for that stat also. I see a comment here, guys, saying thanks so much, that was great. Will there be more? Yes, we will be doing some more in the future, and we will let you know, as well as we have recorded this one and we'll be sending it to you guys on email and posting it on social media.
Brilliant.
And I think thanks so much for...
Thanks for all the questions. Appreciate it.
Thank you so much for joining us today, Kingsley, and thank you for everyone for taking your time out of your day. It was really great having you on our webinar. Thank you.
Appreciate it. Thanks very much, Sean. Thanks, everyone.
Thanks, everyone. Have a good day. Cheers.
Bye-bye.